Hello there and welcome to the Hashpower Academy. My name is Jake, I'm the lead educator here at the Academy, and the topic of today's video is how high can Bitcoin fly? Now, here at the Academy, we teach from a fundamentals first perspective when it comes to Bitcoin, delving with the energy sector first, then going into Bitcoin mining that consumes that energy, produces compute power, network hash rate, and captures all of those 450 Bitcoin that is distributed in 144 blocks per day. Now, all of that is important in the context of today's video, looking at price, for the reasons of, well, let me roll it back. I used to trade, I used to do all of the weird and wonderfuls, build algorithmic systems, scripts, indices, anything that could give me as much information about trading as possible, because you want as much information to make clear decisions. And it was only until I got into Bitcoin mining did I truly understand Bitcoin from a price perspective. And think of it, how many of your friends that trade, maybe, how many of them actually understand mining, not just from a technical side, but actually the economics and where the production floor aspects come into this? And this is where I want to go with this. You've got to understand Bitcoin's underlying fundamentals. Otherwise, you're going to the supermarket and trading goods without actually knowing what the farmers are doing with them and how they produce them and the underlying aspects of how the cost basis of Bitcoin can be from electricity, not from dollars. And so what I'd like to delve into is we'll go into the upside, but you've got to first understand this. Bitcoin right now has a network average production cost of about $50,000. Now, this is important for a couple of reasons, but we'll start with this. Price trades as a supply and demand dollar premium on the consumption side of Bitcoin. And if you're productive and you have access to cheap electricity and computers, you can produce at a lower level. And as a network average, it's about $50,000 per Bitcoin that miners produce at. So that means that they spend $50,000 on electricity, that's their cost, and they produce 1 Bitcoin in this example. So spend 50, earn a Bitcoin, but with the cost of the machine over time getting paid off. Now, this is important because what if the price of Bitcoin in this example was to drop below production and the miner had the ability to sell the power back to the grid? So if he had it at the same price, he sells his electricity here back to the grid, or even slightly higher because they contract lower rates, so they might be able to even capture a higher price. So this means that if the price goes below production, the miner isn't doing the typical arbitrage of buy energy, sell Bitcoin by producing it, but the other way round. That is to sell the energy and buy the Bitcoin. Because if price dropped below production, if price was 45K and production was 50, he sells the electricity, gets his 50K and buys 45K Bitcoin, so he could buy slightly more. Now, this is important in the context of this. If price is at the same as production, that's a ratio of 100%, 1-to-1. But if price was 200,000, that ratio of 50 versus the 200K, that's 25%. Or halfway through, the 50%. And it obviously keeps going up and up and up, and the percentage gets smaller. So basically what I want to offer as a piece of information is go into the Hashpower Academy and learn anything and everything that you want to do about all of these layers, and we'll learn about how production cost relative to price is the best decision-making percentage even to buying. When price is close to production, use this percentage as a multiplier for your purchase amounts of Bitcoin, whether it's a DCA. And when price deviates really high from production, use a lower percentage. And this percentage of the difference between price and production is just a really great decision maker. Because how low will Bitcoin price go? Well, if the price is shot up to here and you're like, should I buy at 300 because I think it'll pump to 400? I don't know, it's up to you, but I have an understanding and a fundamental knowledge of how low Bitcoin price could go. But let's take this example. Let's say the price has shot up to 300,000 and production has raised up to well, let's be nice, 150K, right? Well, now the percentage is between the price to production premium is the percentage between 150K production floor and the 300K, which brings us back to the 50%. And what I'm trying to say is if price, as we've discussed at the start, goes below production, well, that means that there's a natural buyer that steps in who sells their power and buys Bitcoin, the producers of the network. And the easy example for this is when Sam Bankman-Fried was trying to suppress the price of Bitcoin below $20,000. What he might not have realized is below $20,000 was the point in which he was trying to push the price below production, and a natural buyer steps in, the miners, the most hardest believers in Bitcoin, because they don't buy Bitcoin direct, they buy computers that will accumulate it over time. So their belief in Bitcoin is so strong that they don't even buy Bitcoin directly. They build out the network infrastructure for the system instead. And yes, continually over time, both of these will change. Production's continually changing with the amount of hash rate online. So the difficulty adjustment is a good metric for you to understand the amount of hash rate and the amount of energy within the Bitcoin network. In fact, the three layers I like to refer to it as is network energy, network hash rate, and network revenue. The embodiment of consumption and production with compute in the middle as that clear gauge as to how much compute and Bitcoin being settled per block. Because all the different moving parts, if the halving comes along, the production floor doubles. And I actually like to call it, for the miners, the halving is the doubling, because their revenue cuts in half, but their electrical bill stays the same, which means their production floor doubles. But for everyone else, they're calling it the halving, but yeah, to miners, it's the doubling, so to speak. And that production floor continually increasing alongside price gives you the best percentage difference between as to gauging the value of Bitcoin. When the price is close to production, really good value, really good opportunity to buy, because you can buy at the same rate that miners produce with all their millions of dollars of hardware, compute, and infrastructure. And how far it deviates away, well, that's the premium. So what you're doing is you can compare the reward, what you think the upside is, versus the risk, which is the downside to the production floor. So you have a dynamic decision maker of how much risk versus reward that you're willing to take. And this works, I don't recommend selling Bitcoin, but it works the other way around. You can understand, is it a good time to sell? Absolutely not, if it's the production floor. Is it a good time to buy? So you could essentially do, if you want, 1 minus the percentage price difference between price and production. But I'll do some more videos on this. But the key gauge here is that everything in the Bitcoin network is moving, and price isn't just the dollar to Bitcoin exchange rate. It's the electricity to Bitcoin exchange rate through mining. And you don't have to delve into mining, but at least learn the economics behind it. And this is why we call it the Hashpower Academy, because Hashpower is that bridge, the wormhole between all of the physical side of Bitcoin and the infrastructure being built, and the digital side of blockchain and all the different layers being built on top. So I hope this was an interesting video. I liked making it, and I will look forward to the comments section and send this video off to the group chats, the trading chats, and hopefully I'm sure someone will build some interesting indicators with this sort of knowledge. I'm sure the smart money's using it, and I think you guys should too. This is also not financial advice as well. I'm going to throw that in there as well. So enjoy, and I will see you in the next one. Goodbye.